This episode is proudly sponsored by ShakePay, Canada's easiest way to buy and earn Bitcoin in 10 minutes or less with no deposit or withdrawal fees. It's so easy, even the boomer can do it. Guys, I've personally been using ShakePay for several years and highly recommend them. Their mobile app makes it super easy to buy and sell Bitcoin. All you have to do is e-transfer directly to your ShakePay account and you're ready to go. So head over to shakepay.com or download the mobile app, use the referral code Loonie Hour and get $30 of free Bitcoin when you sign up. ShakePay gives out free Bitcoin to every user every day just by shaking your phone. They call this the shaking sats feature. It's awesome. I highly encourage you to go check it out. ShakePay has also just launched one of Canada's only Bitcoin cashback prepaid credit cards, which gives users up to 2% Bitcoin cashback on every transaction. If you want to opt out of Canadian dollars and start earning rewards through Bitcoin, go check out ShakePay. Once again, guys, that's shakepay.com. Before we get started, I just want to remind everyone that this information discussed today is not intended to be or construed as investment advice. Please consult a professional advisor before putting a loonie in any of these financial markets.
The dirty secret is that no one's ever going to get paid back.
People have the shortest memories when it comes to investment.
We just got to get Keith into Bitcoin.
Hey, there's a bubble. Welcome back to the Loonie Hour, episode 56. As always, joined by the three amigos. We got Keith Dicker of IceCap Asset Management, and of course, Rich Diaz with Acorn Macro Consulting. Welcome back to the show, gentlemen. What's going on?
I'm all muddled up. It's daylight saving time. So I was totally asleep when you guys messaged me to get onto the Loonie Hour podcast. I thought I had an hour to prepare and to nap and to get ready. So I'm just catching up. But the markets are down, oil's up, and the Republicans are going to absolutely crush the Democrats in the midterm elections. So we'll see. All is well, I guess. If who knows? We'll see. We'll see in a couple of weeks if all is well or not. Anyway, that's it for me.
Rich, you mean you prepare for the podcast?
Yeah, sadly I do prepare for the podcast.
It's good. Hey, I'm having a fun week. We'll have a great conversation, a great chat, but this was the Fed week, and we always like to say, you wake up in the morning, is there any news coming out or data points to help you decide whether to continue with your view or change it? And I think this week's Fed meeting was one of the biggest that we'll see in a long time. And they hit it out of the park, I thought. So we'll go into that as well. And, that lines up. So we're making money this week. So I'm happy. Unlike Rich, I wasn't taking a nap today. I was counting money.
I've been long oil for 6 months. So I didn't need to count my money. I already knew I was up.
See, when I'm counting with currency stuff, it's like 1, 2 with energy. Rich is going 10, 20, 30, 40.
I need you guys to help me out with the GoFundMe here. Being in Canadian real estate, it's
it's been rough.
The beatings continue, which we're gonna get into. So we've got the actually, by the way, before we get into this, I don't know if you guys saw the Arrive scam app is now being audited. So hopefully they audit the reviews as well.
I'm shocked by this because it had spectacular reviews. It was a highly rated, very useful, and universally approved and loved app. So, I mean, I don't even know why they're bothering. I think we should just put it to the side, water under the bridge. Let's just all forgive one another for the trespasses over the last 2 years.
That was going viral, by the way. If anyone didn't see that, it was like, what was it? The Atlantic that wrote the article. It was like, everyone just needs to forgive everybody and just and move on from this pandemic thing. And then people were making all these viral videos being like, forget, it was pretty funny. But hopefully the reviews get audited. So the Loonie Hour is the only legitimate source for authentic reviews, which reminds you to go and leave us a 5-star review for this podcast. But let's segue into our usual opening here, which is let's get through some of the Canadian news, starting with housing. Of course, I'm here in Vancouver, so Vancouver home sales for the month of October. We've got some data for Vancouver, Toronto. Sales were down 46% on a year-over-year basis. It was the fewest home sales since going back to October of 2008. So a very, very weak year. Obviously, October 2008 was a month after Bear Stearns basically went under. So, we're comparing sales to that. That was the last time we've seen figures around these levels. New listings continue to remain low. Similar story in the GTA. So we had Toronto home sales were down 49% on a year-over-year basis. New listings were also at 12-year lows, the lowest levels since October of 2010. So, yeah, either way you slice it, continues to be the same story. Mortgage rates are elevated, too high. They're crushing demand, but we're seeing sellers basically digging in their heels and starving the market of inventory, which I think is actually supporting prices. What's interesting is actually the median sales price for all property types in Vancouver actually went up month over month in October. I think that's noise, in my opinion. So anyone that's reading that, I think that's noise. I think we're still seeing prices edge lower, but they're firming up a bit. And I think it's just more of an inventory story. Just to give you guys a bit of context. So we were basically running at sales volumes equivalent to, again, like October 2008, right? So we're basically looking at financial crisis levels of home sales. The only difference is today, and both this is equivalent in the Greater Vancouver and in the GTA, is inventory levels are quite literally, they're half of what they were in 2008. So we have.
There's George. George approves.
So we've got home sales running basically at levels last seen during the global financial crisis and the depths of 2008. But the only difference is that you've got inventory levels at quite literally half of what they were in 2008. So basically, I think that comes down to like the sort of financialization of housing, which is everyone's got all these investment properties. Everyone's just saying, you know what, the rental market's strong enough. Let's just take it off the market, hold it, rent it out. So these are markets that, for whatever reason, you can pontificate as you wish, but refuse at this point to be oversupplied.
And how does my only question, because I'm kind of got distracted, frankly, but was how does this population stuff factor into this, or it doesn't yet? Or are developers, are renters, are people who are sort of speculating on the housing market, do they even consider that piece of information, or is that just too far ahead and then we're just trying to get through this cycle and survive and then move on?
I think like every person I talk to in the housing market, buyers, sellers, developers, whatever, everybody always talks about immigration. That is definitely like the bull argument. Again, maybe I think, you could argue that maybe part of it's flawed. Maybe it's kind of like hopium, but people definitely bring up that topic of conversation, say, well, we're keep pulling in more people here. Everybody wants to live here. And again, right or wrong, that's the argument. And what is interesting is obviously we had an announcement from the federal government, here in Canada just this week. So we had some immigration. They just bumped up immigration targets. So Canadian government will increase its immigration targets to 485,000 new immigrants in 2024, and then increasing it to 500,000 new immigrants in 2025. So what's interesting is that we've already admitted 485,000 permanent residents this year already. So we're well above the target of 432,000 people for 2022. So we've actually overshot the targets, and Ottawa's just raised them again. What's interesting, there was a comment from Ben Rabideau on Twitter post this announcement. He says, quote, "I had a federal MP telling me via DM that high immigration supporting house prices was one key consideration in the government's announcement for increasing targets."
So they're not interested in affordable housing at all then?
No, they never were.
Okay. My question, listen, the reality is Canada's an enormous country with probably the fewest or the least amount of people per square per square foot of any major country. But is it still true that everyone just goes into those two cities, Vancouver and Toronto? Because I mean, listen, if those 400,000 people were spread evenly across Canada, I don't think it would be such a big deal. But I mean,
I would,
go ahead.
I would agree. Like, okay, so my always thought process here is like, definitely people always tend to funnel into like the major metros. Like, where's the economic opportunity, right? Like, if you're coming here to work and have a job, the jobs are obviously in the GTA, and then I think Vancouver is probably number 2 in terms of like decent jobs. Now, again, don't get me wrong, cost of living stinks, but like at least you got a decent job. If there's things to do, it's a big major metropolitan city. The weather is like half decent. The reality is that, yeah, I think people do ultimately funnel into these 2 major metropolitan cities. I think, like, if you compare it to like the US, which is hard to do, obviously, but if you look at like some of these like decent sized like cities in like Canada would be like remote towns in the US.
Yeah.
Like 100,000 people, like that is like a tiny town somewhere in like rural United States. But like in Canada, we're like, oh, it's a pretty big, like Kelowna, it's 100,000 people. Like there's lots to do here. Like that. Well,
Halifax has 400,000 people, and it's an enormous city. It's one of the top. It's the largest city in Atlantic provinces, and
400,000.
What's
500,000? Sorry.
Don't forget me. 400,001. You got the order a bit reversed there, guys. So the way immigration works in Canada, there's a quota for each province. So if you apply and you're accepted, you have to go to the province that you're assigned to. But then once you're in the province, I think you might have to stay for a year or something like that. Then they filter back out to like Toronto and Vancouver and everything. So they don't.
You're laughing. That's not serious. We know that you can't be honestly believe that that's the way that works, though.
Yeah, you go to the province. That's where you come into, and then you filter out afterwards.
Somebody fact check us. Someone that's listening to this podcast, fact check us an email.
But okay, because
I mean, if I'm an immigrant, like, let's be honest, like you come from like, I don't know, wherever you come from.
France. There's loads of immigrants from France. For example.
Don't know. Okay, let's say you come from India. Like that's like our number one destination right now for new immigrants is coming from India. You come from like India. Nice, like hot weather, and then you get airdropped into like Saskatchewan. Like I don't know, man. That's a culture shock. Like, those are going to be some tough winters. So I mean, I get it. And then you're like, oh, well, I'm going to go somewhere else, and you end up in Vancouver. Like,
I'm pretty sure that's the way it works. So,
okay.
But next topic, let's go on to the next one. But that's the point, though. If you get hot dropped into somewhere in Saskatchewan or in Kitsilano, like you want to get out of there right away. So you're going to go somewhere else. But anyway, we'll get
Whitehorse.
Check it out for us. Yeah. Whitehorse, all that. Halifax. Let's talk about something a bit more interesting, like
Oh, I got one more note on here. Hold on. Our last little Canadian thing, because everybody loves the pinpoint home capital. So home capital, you guys remember that was like, everybody was short selling it. I think in 2017, you had the infamous Mark Cohodes all over it, mortgage fraud, and ultimately was bailed out by Warren Buffett in 2017. So this is per National Bank. So they had a research note out this week saying home capital borrowers could face up to an $1,190 increase in their monthly mortgage payments over the next 12 months, as up to 66% of its borrowers will need to renew their mortgage within 12 months. So pretty big, if you're looking for sort of maybe some more inventory coming to market, as we talked about, inventory levels half of what they were in 2008. I think that's a possible scenario where you get a lot of these people. Remember, HomeCap, Equitable Bank, these are alternative lenders. They're not tier 1 banks, they're tier 2. So if you can't get approved at RBC, you typically would fall down the ladder. You go to Home Capital. Home Capital typically issues 1 to 2 year loans. They're typically always short duration loans. They're usually stopgaps, right? Like if you can't get approved at RBC, you go to Home Cap so you can close on your purchase. And the idea is that, you'll clean up your balance sheet or what have you. and house prices will go up. You'll refinance out of home capital, and you'll go into RBC. Obviously, that's extremely difficult to do when house prices are down and interest rates are up. So a lot of these people that took 1-year terms with home capital, say a year ago, are now coming up for renewal, and they are going to see massive payment shocks. So these are almost like your teaser loans, almost like in the US back in 08. Maybe not to that extent, but you get the point.
And did the report, Steve, give us indication of the value of those mortgages that are coming due within
I just did it on the
6 to 18 months or so?
I'm just doing it based off of an assumption. If they're saying an average increase of about like $1,200 a month, that should mean your typical loan would be around $500,000. That's a guess. I don't have the exact figures, but if your payment's going up by $1,200, that should be around a $500K increase.
It's interesting because it sort of ties in a lot of the stuff that we're watching now. And, one thing is we talk about, are we going to go to a recession? And most people are now saying, yeah, we're going to have a recession. And then it's, are we going to have a hard recession or not? And I still don't think we're starting to see and Rich will confirm this for Canada and as well as for the Americans, but we're not seeing the hard data yet that's confirming it. But I'm starting to hear some anecdotal stories that things are getting a bit soft out there. I know Europe is looking pretty bad. I know Rich has some data on that, and that's showing up already. But it also ties into what the central banks are doing and what they're not doing. So can we go to the Fed now? Is this the moment?
Boom, the big Fed meeting. Keith had his popcorn out the other day watching Jay Powell's Fed meeting presser there. So give us the whole breakdown. Obviously, Fed raised 75 basis points. I think that's what markets were pricing in. There was some hopium that they would do 50, but it looks like they went 75. And give us your thoughts.
Well, hope is never a great strategy for the investment world. So you don't do that. So to set this up, though, and then this is our view. Ice cap view is that all the other central banks are started to pivot in a way, and people think the pivot is the real hard 180 turn, and it's not that at all. It's just that you've suggested you're not going to raise rates aggressively as you were, or you're getting closer to the terminal rate and stuff like that. So in our mind, the Canadians did it last week, the Europeans did it, the Aussies did it, the UK did it this morning as well. So now the stage was set for the Americans, and they're coming out, and they're thinking, okay, are they going to do this soft pivot? Which means, even if they do 75 basis points, which was 100% expected, by the way, no one was expecting anything else. Everyone's looking for a key. Are they going to suggest that, maybe they won't raise aggressively the next meeting and then they're done? So do you guys remember the great actor from the 80s, Rodney Dangerfield? Do you guys remember him?
You're really dating yourself here.
Yeah, he ranks
comedian, maybe great actor. I don't know. It's a bit strong.
He didn't get a lot of respect, but I thought he was pretty good.
Oh my God.
But he did this really cool movie called Back to School. And in the movie, he went to university, with his son and, did Rodney Dangerfield things. But he was on the swim diving team. And they needed him to come through in the end to do this crazy dive to get the highest point total necessary. And that would smooth everything out and make everyone happy. So it's called the Triple Lindy. And, as the story goes, only one of the guys attempted this. You start at the top board and you hit 2 or 3 other ones on the way down and come back up again. One guy tried it, I think a Russian, and he died twice on the way down. That's how dangerous this thing is. Anyway, Rodney Dangerfield, he executed the Triple Lindy and everyone was happy and stuff like that. The Federal Reserve yesterday, Chairman Powell, he was trying to do the Triple Lindy. This is my, I don't think the Wall Street Journal wrote it this way. So this is my version of it. So they got through the statement and the market took it as being somewhat dovish and markets were starting to rally. And then he got into the presser. And one of the reporters actually said to him, he said, so right now markets are actually liking or enjoying what you're saying. Equities are up, credit is up, and the dollar is down. And my God, Powell looks at the guy and says, whoa, okay, I'm going to switch this around because you guys are not listening to me. Because remember we said before he came into Jackson Hole, he had like the 45-second speech. He says, I'm going to keep raising rates. Let's stop inflation. That's what he did during the presser. And, markets did a complete 180. And the reason they've done that, because now all of a sudden we have all the other central banks which have done this soft pivot. And now they're waiting for the Fed to come in line with him, and the Fed didn't. And so what's really interesting about this is a couple of things. So one of his specific lines that he said, you know what, it is very premature to begin discussions when we will pause the rate increases. And that just caused the markets just to puke. The other thing I want to talk about, people talk about, Paul Volcker back in the 80s. And I don't think a lot of people realize what his experience was back then. So when he came on, it was in the late 79, whatever. He raised rates by 300 basis points over a very quick time frame. And when he did that, then he stopped because a recession was coming on. So he created the recession, and then he quickly reversed those 300 basis points. So he went up 300, back down 300, and this happened within about a year. And when he went back down again, then inflation took off again. So then he increased rates another 400 basis points. And he created another recession, this time a deeper recession in America. But that's what finally broke the back of inflation. People think, he walked in like Noel Gallagher going to Oasis on day one, and just writing the music and saving the day. He didn't do that at all. He went in, he failed the first time. He realized his error, and then he went harder back at it. And that's what Powell and the Fed can see today. They know that if they stop prematurely, there's a chance that they're not going to, nip this inflation problem in the bud. So that's why he continually comes out. And that's what he referenced at Jackson Hole as well, by the way. So from an investment perspective, we continue on this path with a probability of a crisis taking place in the sovereign debt world. It's still there. Like it's getting tighter and tighter. And that means that, the risk will come out. And I think it will be in the FX world. So that's why you're getting this, market here, Thursday here right now, it's FX is coming off pretty hard, and same with equities as well. But that's the beginning shot of what happened at the Fed this week. Again, it was a spectacular meeting, and it was the presser, right? It wasn't the actual statement that they came out with. Rich, wake up.
What's the update on I'm just listening to you in amazement. What's the market's expectations now for the terminal rate? So where they expect the Fed to basically finish the rate hiking cycle. It moved up after the presser, didn't it?
You're gonna have to give me a second here to check it out.
Fire up that Bloom tube.
Well, I mean, I just while Keith looks at that, I think what's also important is to remember and to think about where the sell-off occurred. And I think that's where, I think that's very indicative of sort of the motivation that Powell might have with respect to what he's doing with the Fed funds rate. It's not clear at all that it's going to ultimately affect inflation until it gets much higher. And it also might take longer for these rate hikes to feed through. But I think it's, if you look at the tech sector, consumer discretionary, it's absolutely driven the declines in the market. There are some sectors like financials, utilities, telecom, healthcare, they were down. Of course, it's tough when the entire market is down, almost 3% over 2 days. But I mean, there's hardly been any movement in some of these older kind of non-long durations assets. And I think that's what's partly motivating this view. Early before we got on, Steve, you were asking me what's going on with the tech. And I think, there's two types of tech. There's a speculative tech that's been continually hammered, and there's the consumer discretionary stuff that's, on you talk about hopium, long duration assets that, are basically disconnected from reality and totally valued as a result of a very, very low interest rate, low denominator. And then you have the tech, and tech is down 5% over 2 days. It's the worst performing sector over the last 3 or 4 weeks. And I think that's really where this froth, I think that's the appetite to get this froth out of the market. So because you're seeing utilities, financials are actually are holding up really well. Telecom, energy, we've talked about that a lot. So I think it's also important to look at how the market's reacting and where the losses are building up.
The losses are building up on millennial balance sheets that are long. Facebook and Amazon.
Amazon.
I don't know too many young kids these days that are loaded up the truck on oil and gas. But
well, we talked about bellwether stocks and things to look at. I mean, Meta is down. I mean, just an incredible amount. Spotify, Google's one of those that's going down. But, other stocks are actually held up relatively well. I mean, if you look at Bank of America, it's made a new high. Exxon made a new high. Roche, which is a very important healthcare stock out of Switzerland, that's making a new high. Even SAP out of Germany. Total, again, another energy company. So, I mean, it's not exact. I mean, yes, there are lots of losses, but the market's also telling you that there are some stocks that are going to be able to weather this storm, again, in relative terms. I mean, Walmex, I've been after this Mexico story for a long time. That's just making, almost a 6-month high. So it's not, I think that it's important to look at the different sectors and see what the market is telling you with respect to the Powell messaging, et cetera.
Give us an update on the Bloom tubes.
I was buying you time.
You bought a lot of time. That was really good. Okay, so before yesterday's meeting, they're expecting 275 basis point hikes. So they did 75, which meant the terminal rate was around 475. So they're at 4 right now. Right now, the market is almost pricing in 5.25. So it's almost an additional.
For what date?
This is out, Rich, to May and June. Like by May, okay. Like we're at 514, 515. Of course, which they'll never hit
terminal
that
rate. Oh, you don't think so?
That's what,
you don't think they'll get there?
Well, they won't increase by 14 basis points. They're either going to do 25 or
no. I'm what I mean is like they're not going to. You don't think they'll reach 5.25?
I don't know. My view with central banks, and I love it when they're consistent. And in my mind, the Fed they're going out of their way to tell you, don't try to stop us, right? If you're betting against us, we got a lot more money than you do, and you're just going to fail, right? Yeah. Whereas the Bank of Canada, they flip-flop last week. The Europeans, you never know what they're going to do with their monetary policy. I thought the UK this morning was brilliant. They did 75 basis points. So the Bank of England did a hike by 75 basis points, which was more than expected. And everyone started the hyperventilating. But then they said, we're actually not going to raise rates anymore really in the future. We might do one more, but we're basically stopped now, and that's it. Which the market just made. Right now, sterling is off almost 3% for the day, which is outstanding.
It's an incredible number. Again, people don't understand for stocks to go down 3%. You can sort of understand that happens fairly often. For FX and to a lesser degree bonds, 3% is an incredible number. Just so people,
yeah, Rich, understand. That's like a 8 or 9% day on the Nasdaq or something. Like it's pretty big. But again, like with the Fed, they're being pretty aggressive. So back to your question, what do I think they're going to do? I know they're going to keep raising until they tell us, they're not going to raise. And that's not it's kind of funny because, right, like the big, investment news channels, they always get talking heads on, what do you think the Fed will do next and that stuff. And, it's great conversation, but it's a waste of time. Instead, just listen to what they're telling you. And right now they're telling you, we're going to keep raising rates. And that's important to know. It's important to know because everyone else has really said, we're going to stop raising rates. Here in Canada, who knows what the Bank of Canada will do next? Like I have little confidence in understanding and in appreciating what they're going to do. As an example, I don't know if you guys noticed, was a little press release by the Bank of Canada this week. And they actually announced a soft QE scheme. Did you guys see that?
Yeah. But I'm not sure. I think we're over it. Go ahead. Tell us what it is, Keith. But I think
Keith, you can get into it. I was like, someone sent me that article and I instantly texted like all the contacts that I had just to kind of get some feedback on. I think it's more just like a liquidity operation for the federal government. But anyways,
how would the Feds need liquidity on short paper? I don't get it. I mean, try to sell me that story. I would, if it's a long dated paper, like, you're doing like a 50-year issuance or something, or it's credit. This is the federal government issuing short paper, and they want the Bank of Canada to come in to help smooth out liquidity with it. I don't understand. Maybe there's some timing issue going on with pension funds and banks and stuff. And I hope that's what it is, but it's just a little bit funny. But again, it's back to my point. You got some odd things taking place. Another thing to think about, as a result of the Americans raising rates yesterday in Hong Kong, they had to jack up rates as well, because their monetary policy is tied directly to what the Americans are doing. Did you see the Hong Kong GDP number? Did you guys see that?
Yeah, I saw that.
So they
Massively
so
down.
yeah. So previous quarter there was minus 1.3, which shouldn't be a shock. I mean, like they're shut down. No one's doing stuff. This number that came out for the next quarter was minus 4.5. So they've gone from minus 1.3.
By the way, the expectations were like negative 0.5 and or negative 0.8 or something. It was like sub 1. So it was a massive miss.
So I've got some anecdotal stuff. I got an anecdotal story about Hong Kong. Oh,
whoa,
sorry.
Go ahead. Stop.
Don't cut the boomer off.
Come on.
Sorry, I thought you were done.
No, I'm doing the triple Lindy. I'm going to get ready here. But people need to appreciate when you raise rates like that, you're actually sucking capital out of the system, right? So it's the same thing as the Bank of Canada raising rates. So in Hong Kong, they have a property challenge that's taking place. The banks are not lending, and all of a sudden rates are going up. It's making it more. So they're raising. So in Hong Kong, they're now raising rates aggressively during a really sharp recession, and it doesn't work, guys. Like something like that, just breaks. And so you bring that back to Canada. Of course, there's a couple of things to think about. Again, I think something does accelerate in some kind of crisis around the world. Not Canada first, but we will feel the effect of it. But think about, though, if we do go into a hard landing now in Q1, we'll have some of these, side effects coming here as well. So what do you got there, Rich? Sorry about that, Rich. What
no, not at all. It was my bad. Listen, I was just going to say, like, I've heard anecdotal. We've talked about anecdotal evidence before, and we talked about hard evidence. And one of the anecdotes that I keep hearing is that companies are just simply employees, whether they're lawyers, whether they're people who run operations for other parts of Asia out of Hong Kong, they're just shifting those operations to places like Singapore, Indonesia, and I can't remember the other one. But anyway, so it's amazing. These people are just picking up and moving, and the hard data that sort of corroborates that anecdotal stuff is the housing market, which for many years in Hong Kong was just a spectacular rocket ship, fueled through foreign capital, Chinese capital, etc., has now made, I think, like a 2 or 3 year low. Now, house price indices, as Steve always tells us, they're lagging. They're tricky to sort of identify and corroborate. But it's just amazing. The house price index for Hong Kong is making fresh lows virtually every month.
Which basically tells you that it's worse than whatever that home price index is suggesting.
What I was going. Yeah, that's it.
Sorry.
No, that's it. No, that's exactly right. No, I'm happy you said it. That's exactly. I couldn't have said it better myself.
It's the only value I can provide, so I figured I'd chime in and
go for it. Go for it.
Home price indexes.
Did you guys hear what Christine Lagarde said from the ECB this morning?
Former criminal Christine Lagarde. Carry on.
Was she convicted or just
she's
charged?
She was convicted for fraud and
for fraud.
For fraud, and they bent the rules to let her to be the ECB president. You can look that up.
It's kind of interesting if you think about it. Hey? You get convicted for financial fraud, and then you end up becoming the head of the entire financial system. What kind of world would allow that? I know one.
Well, a fantasy land. There you go. There it is.
Bingo, there you go. Yeah. Rich is coming on side.
I'm coming on side. That's right.
Yeah.
So what's Lagarde going on about?
Yeah. So this morning, her quote was, "A recession won't be sufficient to settle inflation."
Okay.
Duh, it's an energy crisis for Christ's sake.
But it opens up, simply saying, well, is it a depression? Like, what do they need to settle in inflation? So if a recession isn't good enough, I mean, who knows? But my point is that they're not, the central bank, they're not in control. The actions they're taking is to create a softer economy on one hand, and they're trying to bail out Italy on the other hand. Rich, why don't you jump into some of the economic data for Europe that just came out over the last 48 hours?
Well, I was just going to chime in there quickly. Is this not like one of those situations though, that like, we've talked about in the show before, which is like, if Lagarde's saying, listen, a recession is probably not going to be enough to tame inflation, like, is this not a scenario where at some point, I'm not saying it's now, I'm not saying it's in a month or 2 months from now, but at some point, central banks might just have to grapple with the idea that we're going to live through higher inflation for the next couple of years, and it is what it is. Like, you're just going to have to suck it up, and maybe inflation averages 3 to 4% for several years.
Congratulations, Steve. You've jumped on the winning side. Welcome. There's a place of honor right next to me. You're welcome to join us.
I mean, that's been my view for a while, but I mean,
I know. I'm kidding.
You know what I mean? Like, it's just, it doesn't. Yeah, it's. I don't know. It's pretty.
So I agree with you. She's a politician. Make no mistake about it. Unlike Draghi, who is more of a technocrat / politician, she is purely a politician. And I think this is part of the messaging to get people behind the fact that we're in a world of financial repression. Inflation will be sustainably higher than interest rates, even though interest rates are rising. And we talked about real haircuts to debt burdens. This is how you do it. You inflate it away. I know Keith doesn't necessarily agree with that story, but I think this is just one of the steps on the road to disaster, perdition. Who knows?
Okay, I got another question for you.
Yeah.
Where do you
Rapid
guys?
fire. Here we go.
Yeah. Where do you guys see? Where do you see the bond yields in the next 6 months? In general, Canada, U.S., any sort of important.
Rich, the bond yield is the income payment you'll receive on the bond if you apply an inverse diffusion index to it.
Don't be mean. I did my CFA.
Don't get this guy revved up about diffusion index. I'm just curious, like, over the next, let's say, 6 months, like, where do we see them in 6 months? Like, do you foresee like the narrative of like, okay, we're clearly in recession, weak growth, so bond yields are falling, or do you feel that inflation just continues to be persistent and they're still at today's levels or even higher? Like, what's your opinion on that? I think the markets are definitely very, very divided on this, but
Keith, age before beauty. Go ahead.
Yeah, so the Americans now, their 10 years about 4.15. We could get a spike to 5, but I think we're in this topping phase. And the reason I think that, because I think we do get a hard landing in America as well. And so along that path, I can see the 10-year dropping back down to 2 or something if we get a hard landing in the US. It means corporate debt is widening. Like, that doesn't do very well. But I really think we're set up, for this deflationary boom, from bond markets having a crisis. And that's where we're going. What number do you got, Rich? What do you think?
So, I mean, it depends on how you look at it. So over 6 months is really quite short term. I think they'll probably be around where they are right now. I think it'll take, I mean, that's kind of a boring answer, but I think that's my answer. I don't think they'll be much higher or much lower. I think if the market really was convinced that there would be a recession, I think it would be starting to price that in now. And that's not what we're seeing. We're seeing even on a day or on a week where Powell is dead set on telling you that he is going to raise rates and effectively try to cause a recession, the bond yields are up, so bonds are selling off. And so that's where I don't think the market is yet convinced, and I think it's going to take longer than 6 months for that so-called recession to come out. On the other hand, there's a way, then there's a way of valuing or what you think is the fair value of bonds, and usually you do some kind of, and that's like the long-term boring answer, which is the nominal GDP growth plus some kind of inflation. I think on both those cases, I think we're going higher. My fair value is like 5.25 for the 10-year bond yield. And so I think that's where I would say over the next 12 months.
Okay. There's no agreement. That's good to know.
What's interesting though, like again, from the UK this morning, one of the quotes was, we're trying to prevent gilt yields from exploding again. So I really do think we are in this environment where governments and central banks are very aware of their bond market, of the government bond market, and they're going to do whatever they can to try to hold it together. Like if you ask the question, where would the Japanese 10-year be? A year from now, a century from now, whatever. It's not going to budge from where it is. I think it does.
Yeah, that was my answer.
Yeah. But again, the challenge with the answer to this question, Steve, is that it assumes it's a normal economic cycle. And if that's the case, Rich and I can give a really nice answer. We'll, tick and talk and the yield will settle where it is. But I really think, though, we're going to see some kind of crisis in the bond world coming up. And like if bond investors thought, the last 15 months were tough, boy, oh boy, you ain't seen nothing what might happen yet.
But see, the problem I have with that view, though, is that shouldn't the market's smarter than that? And the market should be pricing in all of this negative information. And so either the market's being extremely sanguine or there's just been a step change in what people are willing to pay for these bonds. And the problem I have with bond yields going down is that you need bond prices to go up. And it's, if you think inflation is going to stay high, which I do, you have a situation where you're just not being appropriately compensated for that risk.
So I think so where you're right is that, if you think about it, it's the US. So around the world, every country's issuing debts. There's a sovereign debt market everywhere. And that is not a true price discovery kind of market anymore. So if you think the Italian or the German or French 10-year is priced correctly, it is not. Like no one's buying it. In Japan, I saw this week, so 100% of a specific government of Japan bond issuance, it's entirely bought up and swallowed by the Bank of Japan. And whereas in Canada, like, it's the pension funds that are buying the debt that's issued. The Bank of Canada are giving QT, but I suspect they'll be back at QE at some point as well. The provincial bond market is highly illiquid. So for that reason, I think the majority of the world's bond market, it will never get to see the light of day again. It's always going to be, let's lock this puppy down. So then by default, it means that the only other market that's big enough and deep enough to get true price discovery is in America. Because again, there's no corporate bond market of significant size and liquidity outside the US. It doesn't exist. So every Canadian that thinks, well, we have this great corporate bond market in Canada, you're wrong, pal. It doesn't exist. But in America, they do. So I think, you could have the opportunity where, bonds are correctly priced we're down in the US, but elsewhere it's going to be this, this fictitious moment. That's what we suspect. What's your next question, Steve? Rapid fire.
Your buddy, the milkshake man, just tweeted, the U.S. government cannot fund itself at 5% forever, but it can fund itself at 5% for a lot longer than the UK can fund itself at 4.5%, and a lot longer than Europe and China can fund themselves at 3%, and a lot longer than Japan can fund itself at 1%. So, I mean, I think that kind of sums it up, really. I mean, you've got these sovereign debt bubbles around the world, and the U.S. is still the cleanest dirty shirt in the laundry hamper.
I mean, the other thing that I look at it is, I mean, just one thing on the bond yield is, I mean, we've been worried about stocks for a while, even though stocks have actually rallied over the last, let's say, 3 weeks or whatever, only to be smacked down by Powell. Is as we were going to talk about economic data. I mean, something that came out a couple of days ago was the Dallas Federal Reserve. Then we had the non-manufacturing ISM, which came in. I think it was slightly lower than expected, but that's starting to really start to roll over, especially when you look at the components. We had the U.S. manufacturing data PMIs come out. Again, new export orders. I think it's been the lowest it's been in 2.5 years. And then, the thing that I'm starting to look at is earnings revisions. Again, we're going on and on about this, but this is really important. So this is where I could be wrong about the bond yield, in the sense that people really do capitulate on the equity market, especially the US equity market. We know they're capitulating on tech and consumer discretionary. They haven't yet capitulated on, let's say, telecoms, utilities, consumer staples, and energy. But if they start to capitulate on those sectors, they're going to need to buy something. And for the first time in a long time, the bonds in the US are offering you, whatever it is, 4%, 4.25%. All of a sudden that becomes attractive in a world where, you're Keith's point about the recession. And so, you start to say, okay, you know what, I'm going to buy these bonds at 4, even if there's a backup in yields to 4.5, because of the duration and convexity, I'm actually kind of protected. The risk reward is now in my favor. So I'll just take that bet, which, might swing a bunch of people into the 10-year. So that's where I could be definitely wrong about that. But I don't know. We'll see. If the Fed keeps raising rates, it'll be interesting for the yield curve to get lower. Was it the most inverted yield curve in 42 years or something like that? Since the 80s.
I didn't know that. That's a
boom. There you go. There's a quick fact for you.
It's definitely true in Canada. It's the most inverted yield curve in Canada.
It's interesting because I just look at it like, obviously I'm housing focused, but so there's a big trend that's happening right now, which is a lot of Canadians, like, this is like the overwhelming trend today is over the past 3-4 months, everyone's been going 1, 2, sometimes 3-year fixed mortgage rates. So instead of going the traditional 5-year fix, people are like, well, I don't want to lock in 5 years at 5.5%, highest rates in 14 years. So let's just bet on doing a 1 or 2 year fixed and hope that, in 2 years time, when I go to renew, the rates will be lower. So that's the overwhelming trend. But now what's happened, interestingly enough, is because you've got this yield curve inversion, is that your 5-year fix is now actually lower than like a 1 or 2 year fixed in the mortgage market, which is not common at all. There's always been historically a discount for obviously going with a shorter duration loan. So it's interesting because the next question is like, okay, well, you've got so during the pandemic, you had all these people that were betting on variables. Well, Tiff Macklem told me he's never going to raise rates. Let's go variable. Obviously, that hasn't worked out very well. And now people are going 1 to 2 year fixed with the expectation or the hopes that rates are going to come down in 1 to 2 years. And that's another wild card, right? I mean, where are rates 2 years from now? It's another bet that Canadians are making. Hope is, I guess, as Keith said, hope is not a strategy, but that's what they're.
It's not a great strategy,
but it is a strategy.
It is a strategy.
I know people use it as a strategy, but it's I hope I get taller, but I don't think that's gonna.
You got to hang upside down in those boots.
Yeah. But what's interesting though, like with this whole mortgage rate cycle, I expect at some point soon the Bank of Canada, they will peak out, and it doesn't matter what the number is, and there will be a pause for a while, and then they're going to start coming down again. So, if I was playing that mortgage rate game, if you're getting a mortgage today, I don't think the upside is that much more if you're on a variable rate. Do you think so, Steve?
I mean, that's my opinion, but everyone's, hey, I had the wrong call at the beginning of the year. So don't take mortgage advice from me, obviously. But I mean, that's my opinion. I think that the economy stinks. I think that the housing market's in recession. I think the rest of the economy is going to follow suit. So, I just don't think there's a whole lot more movement for rates. And I think Tiff Macklem kind of signaled that in his most recent, like we talked about last week's episode, right? I mean, the market priced in 75 basis point rate hike. It was a layup for him to do 75 and he needed 50.
I had to eat a lemon loaf, remember?
Yeah. People are upset about that, by the way. They said that doesn't count. So
that's right. You owe us a Twinkie.
We're holding you to that.
I think that's why in Canada, the US I have some views and maybe we'll skip that for now, but that's why I think the population growth, we keep on harping on this, but that's why I think it's just such an interesting sort of X factor to all this. Because if you have population growth, again, we talked about again, just so people understand, population growth is one way that you sort of increase your GDP, right? You just literally have more people in your economy, so your GDP goes up. If you have population growth of 2%, you will not get a recession. It's unless your GDP falls by more than 2% for those two core, like, you know what I mean? So it will be really interesting how you slow down, let's say, the rental market, how you slow down food inflation, how you slow down transport, how do you slow down retail sales, like all that stuff. If you just have an incredible amount of people just entering into your economy, you have to have, like, you know, it will just be really fascinating how that is incorporated into their analysis, how that affects these numbers. I think per capita, we probably already are in a recession. Do you know what I mean? But just as the GDP as a whole in aggregate, it'd be very, very hard. If you have 2% population growth for the next 2 years, I can virtually guarantee you will not go into a recession in Canada. And it will be also impossible to have your inflation numbers go back down to 2% as well. And so I'm really kind of fascinated by all this. You know, Keith always talks about the left hand pulling and the right hand pushing. Well, man, if that doesn't describe what's going on in Canada with the central bank tightening and the Fed and the government of Canada not going to lower it's not going to shrink its deficit, lots of people coming in, that's extremely inflationary.
I don't know where you're going to house these people personally. I mean, the resale market stinks, but gosh.
They're all going to go to Saskatchewan. That's where they're going.
I think the Loonie Hour needs to get into the tent manufacturing business.
I mean, hopefully they come here with like the understanding they're going to be spending an incredible amount of their disposable income on housing. I think that should be at least a sign at the airport when they arrive. I mean, welcome one, welcome all. I mean,
Keith's got a big house.
Beautiful country. Keith's got a big house.
There's a couple extra bedrooms there.
Have lots of lemon loaves and Twinkies and stuff as well. Back to what we started when we opened the show with, you're talking about like the path where we expect things to move. And I suggested, you know, that they're still going as we expect it. This is not a perfect timing story, but you know, we were suspecting that we might get another leg down in equities, and it would have been confirmed with what, you know, the Fed was going to do this week. So again, this is the way that, you know, our minds think as money managers. Okay, we got that data point from the Fed. So as of now, it looks like we should roll over a bit more in equities. Now, I know I mentioned a few weeks back that I thought we are, you know, potentially starting to bottom with equities, and it might take a few months for that to happen. And I still think we are in that phase. And we got 2 more big data points coming up, and we're almost at the end of the year. So on Friday, which, you know, guys are, you know, listening to this now, we're going to have the non-farm payroll number. And, you know, by now, you know whether it was an awesome number. So if it's a really strong number, this is how weird the market is, right? If we get a really powerful jobs creation number on Friday, what's going to happen to the market? It's going to go down. Sell off. It's going to sell off, right?
Good news is bad news.
Yeah. So you think about it, right? You're like, wow, why is the market selling off? You know, we created jobs for people. But of course, it's a softer like number, you know, markets will do well. And then we have the CPI number coming up in a couple of weeks as well. And then it's, you know, then the year is done. So, you know, but that's for us.
Oh, sorry.
Yeah. I mean, for us, we are starting to see this opportunity to add risk again. And but one thing to appreciate, you know, even during, you know, that this has been a bad year for most markets, there hasn't been any dramatic drop off in the market. You know, it's been this like trending lower, you know, ups and downs, of course, a lot like 2002, by the way, which is one of the worst equity markets I've ever been through. And so, you know, it would be great if we get this 5, 10, 15% smackdown, and, you know, it could happen Friday afternoon, who knows? You know, that would be, you take that as a gift. You say, thank you. And that's your opportunity to start adding risk again. But that's what we're getting thankful for.
Go ahead, Steve.
Well, no, sorry. I was just going to ask Keith. I think you kind of somewhat answered your own my question there, but which is, yeah, how are you guys? How are you looking at U.S. equities, for example? Is you basically, are you at this point? Are you slowly adding? Are you still waiting for a better entry point? I mean, I think we're all in agreement here that we're tiptoeing obviously closer to some sort of financial event. Yeah, how are you doing? How are you looking at that?
Yeah, for our long-running portfolios, it excludes new clients that have come on over the last year. We have not added to equities for a while now. We've been expecting this downturn this year, and that's what's happening. And we're opportunists. We know that we are going to trough at some point. We have a couple of models that we really like, and they're almost at rock bottom, which is when you want to buy. But that's where we are right now.
So
this is trending
getting
as
close,
we were
close, but not there.
Yeah, it's trending as we had hoped. This is the way we were hoping it would go.
So can I answer this question too, which is to say, I mean, we have a similar view, I guess. And the reason I remain sort of skeptical about a bottoming is it's two reasons. And also I'll walk you through my path. And Keith's joke about the non-farm payrolls being good or positive tomorrow is going to be negative for the market. That same thing happened last week. So last week, the JOLTS data came out, which is the
job openings.
Thank you. Job openings and survey, basically. And it surprised to the upside. So everybody was convinced that the job openings were going to fall, especially in, for example, the construction sector, which everyone's convinced is over. I don't agree with that view, but that's a conversation for a different day. And it surprised the upside. And on that release, the market sold off. And so basically, to me, it's back to this whole narrative that the market remains at the mercy of real interest rates. And that's part of the narrative that the market is still waiting for Jerome Powell to pivot to lower real interest rates. So to basically make money cheaper again and to float what was a market built on cheap currency. The problem that you have is that you need earnings. And you just aren't getting earnings. And you aren't getting earnings because the economy is slowing. You're not getting earnings because sales growth, which tracks the economy, is slowing. You aren't getting earnings because margins are at the peak and they're starting to roll over. And so your entire performance, your year-on-year equity market performance is just tracking the increase in price earnings ratio, e.g. the value that you're willing to give for that fixed amount of earnings. And that is just a function of the Fed policy. So unless you have a break in that relationship, unless you start seeing earnings rise and that P ratio in effect stay flat and have some kind of performance, I don't think you're quite ready to go full, I was going to say a very crude expression, but just to go fully into equities. I think you really need to see earnings come through. But before you see earnings, I think you're going to have to see earnings expectations sort of bottom. You're going to have to, these analysts started to reprice what they think what's going to happen with these stocks. And that's not happening at all. The opposite's happening. Analysts are getting more and more and more bearish on the expectations of their individual stocks. And so although I agree with Keith in the sense that we're closer to the bottom than we might have been 6 months ago, I still think that there's room for some damage with respect to your equity portfolio.
Boom. There you go.
Keith, what did I screw up there?
No, it's a good way to wrap it up. Keith's nodding his head in agreement. So as always, we appreciate your support. We're a month out from the Loonie Hour event live in Toronto. So very much looking forward to meeting everyone at the Hockey Hall of Fame. We appreciate your support. Leave us a review. And as always, we'll see you next week.